Let's start with our grain markets this morning and see where we're going to start out this morning. From the overnight trade, just slightly lower on the May corn, down 3/4 at 434 3/4. The July contract 448 1/4, down a penny. December 473 3/4, down a penny. Take a look at our soybean market. Soybeans up 2 on the May contract at 1187 3/4. July still holding on to a 12 handle at 1201 even, up 1/2. November beans 1184, up 1.5. Take a look at our wheat market. Chicago this morning down 3 on the May at 554 even. The July contract 569 3/4, down 3. See what hard red Kansas City wheat's doing. See if there's anything any different there. About the same, down 3 on the May, 572.5. That July contract down 566 even, down a nickel. Take a look at Minneapolis spring wheat. Spring wheat's up 1/4 on the May at 635 even. The July up 1/2 at 645 even. I'm going to touch on cotton real quick and see what it's doing. It was firmer yesterday, down today. May down 44 at 92.32. The December down 5 at 84.30. And one real quick look at this market, because this is the one that's really rolling right now. Crude oil. 84.97 has been back above 85. We were really wondering if it would get back above 80, and now we're hugging in close to 89 now, so or that 90 handle. The June up 115 at 83.97, and I want to invite my guest in this morning, Darin Newsom. Well, I've got this on the board for just a second there, so you can see that inverted price. Darin, this interests me more than anything because energy is what we use to drive everything out there, and it continues to push higher.
Yeah, it's a seasonal time of year. That's a terrible thing to say, but it's just a seasonal move in the crude oil market, and we could see that. You know, we've got some commercial buying. It's a heavier driving season, as you said. Demand starts to go up in the spring and summer, and so when we look at what's going on in the crude oil market, West Texas Intermediate, we see the spot month contract running away from the rest of the market, and so we know the commercial buyers are coming in. They know that inverse in the forward curve is strengthening, or backwardation in New York terms is strengthening. And again, this is all seasonal. This all reflects, demand is picking up. Supplies, still, we're not tight supplies by any means. We're still only at $85, but it is a seasonal move, and we are seeing some commercial buying coming into the market.
The reason I wanted to bring that up is simply because of the corn and the soybean oil. We've been talking about the biofuels. Now that we've really got a new bull market, these are new contract highs for that May crude oil. Seemingly that should add a little support underneath those grains, shouldn't it?
I don't think so. I mean, they both have their own individual, fundamentals. And if we flip over and look at the May-July corn spread, it closed at 13 3/4 cents carry at Monday, and in the bearish 67% threshold is at 14 cents carry. So it was only one tick away. So we've got a bearish supply and demand situation in corn. We've got bullish supply and demand situation in crude oil at this point. It all comes down to demand. Yes, we've seen export demand increase for corn, but that's the smallest leg of the 3 legs of demand for U.S. corn. Right now, it's all ethanol and it's all feed, and feed demand really seems to be an issue at this point.
Absolutely. So you mentioned those numbers on corn. What is it on soybeans right now?
Soybeans, it's still a neutral situation. We had the May-July covering something like 46%. So I mean, it's just really going nowhere. And again, this comes back to the fact, we didn't have we had a smaller production in 2023. So, supplies aren't as large, but our supplies in relation to demand hasn't really changed that much. Basis is sitting a little bit below average. So there's really no fundamental push in this market, despite the fact U.S. has smaller supplies. Again, it all comes down to demand. There just isn't much for U.S. soybeans at this point.
Well, maybe we can stir some of that up from China or somewhere else, or even here in the U.S. as we get some more of those crushing plants up and running. So, Darin, stay with us. I'm anxious to talk a little bit about the cattle market. We're going to go away and take a real quick commercial break. We're talking with Darin Newsom. Stay with us. All right, welcome back to Market Day Report. We are going to have a tough start this morning, and I am really anxious to see whether we're going to be 2 or 3 higher, 2 or 3 lower, and I don't think anybody really knows right now. But we left the day yesterday. I'm not real sure that those closing prices are correct there, but maybe the unchanged part of it is 180.07 on the April contract, the June down 175.32, and the August at 172.10. Don't quote me on this, but I'm pretty sure those are all $3 plus lower, if I'm not badly mistaken. The feeder cattle market was $4 and $5 lower, with the April at 240.52, the May 242.67, and the August contract at 251.65. And note that September. I have made comments about it several times when we were at the 270 level. Now we're at 253.35. So we'll invite Darin Newsom back in real quick to talk about this. Darin, we got a lot of news out there, a lot of unfamiliarity with what's going on. Tell us a little bit. You and I kind of talked a little bit this morning, but I want the audience to know what you see out there.
Yeah, the first thing that jumped out at me once that headline hit around 12:30 Central Time on Monday, the market collapsed. But what was interesting is that we didn't see the pressure coming in. We didn't see it reflected in the future spread. So, and I know I go back to this all the time, but what it tells us, it wasn't the commercial side that was selling. So the headline triggered some algorithm selling. Now, people are going to yell at that, and it is what it is. I mean, that's what drives these markets. So we had some fund selling moving the market yesterday. It's a big move. We'll see, as you said, today things could even out a little bit. We could see a bit of an equilibrium, but I mean, the risk is there, continued non-commercial long liquidation. And if that happens, there's really nothing to step in and support this market at this point. The commercial side's not selling. They're certainly not growing more bearish, but they're also not getting more bullish. And so I think they might wait to see what develops on the cash side. We saw boxed beef under a little bit of pressure, not much, Monday afternoon, but right now it basically looked to be an algorithm-driven move based on the headlines, and now we'll see what plays out.
I'll tell you, the most interesting thing I saw about it more than anything, I looked this morning, open interest didn't change hardly any at all. It was up 305 contracts. We saw, when we broke earlier last week, we saw a drop of about 89,000 contracts, and we're about 20,000 contracts short of where we were at our peak. So I found that to be pretty interesting that we didn't really change anything in our open interest. So you and I talked a little bit earlier about the cash side of it, and I think when they step in those sale barns this morning, we're going to be real interested to see how they want to act or react to this information that we've got.
Yeah, and it certainly wouldn't be surprising for them to try to play a little bit of a defensive game here, because they can always say, hey, this is what happened in the futures market. But if we want to take one step further, at the end of March, we saw both live cattle and feeder cattle complete bearish, reversal patterns on their long-term monthly charts. So, we had an idea that the long-term trends were turning down, and so again, that gives the cash trader something to sit back and say, look, we think this market's coming down. We don't have to be aggressive buyers. Then all of a sudden comes back to, okay, what's on the demand side? Are we going to continue to hold up the boxed beef market, or does it too start to move lower?
Well, and that's an interesting question, because dealing with the consumer here, and we know that the high prices that you and I saw last week at $3.13 in the boxes, that's just now starting to filter into the grocery store. Mm-hmm. And I think there's as much as a 21-day lag to when they can actually put that meat out onto the shelf. So really and truly, the consumer just now is going to start seeing some of those higher prices, even though you and I are kind of seeing them come down just a little bit.
That's correct. And the other thing that really jumps out at me is I think we saw something like a $3.25 spread between choice and select. And that's very narrow. And again, I understand it's the time of year that we're moving into seasonally, this time when you start buying some cheaper cuts for cookouts and these sorts of things for grilling season. But that's still a narrow spread. And so what's that telling us economically? Again, we'll have to wait and see how this all plays out. Absolutely.